All right, let's look at natural gas. So natural gas drops yet again. I don't know, what is this, like the 10th day in a row that we've fallen lower. I still have a position in UGAZ. I averaged down fairly nicely today. When I say nicely, I mean I bought it about 1370 and averaged down. As far as the chart goes, I was expecting this to be a hard support zone. Way back before we broke down, I saw a different version of this descending triangle. I have since changed my ABCDE, but it was a bearish descending triangle, and this should have been obvious to me given that price had moved downwards into the trend. It should continue on downwards, but we have our A, B, C, D, E, and then we break down lower. And right now the pattern that I can identify is a falling wedge, and falling wedges are sometimes pretty vicious. As you can see, we've dropped about 25% in the last week or two, which is pretty devastating to some individuals. I guess I'm sitting okay, but that's besides the point. This green line right here marks our bottom from this time exactly last year. As far as the RSI levels go, we are very oversold, and we have remained oversold for a number of days now. When was the last time we were oversold? It was right down here when we were at our lows of last year again. So this is the first time we are oversold, and I still believe that there is a large profit to be made for those that stick around and hold into the trade, although I don't want to recommend that until we get a more clear price reversal, because right now it just looks like it would be catching a knife. We do see our stochastic moving up fairly nicely. It's consolidating in this zone. Our RSI is beginning to try and break out of this 30 range. It's having trouble. Breaking out of this 30 range would signal us to have a dead cat bounce, and we would probably go to this 50 RSI level and then probably get rejected, come back down, set in our ultimate low, and then move on higher. So that's kind of my price for the short term. These measured moves right here, this is the high of the original descending triangle, and if you count this as just a continuation of a descending triangle bearish version, this would be the scenario that plays out, and it actually fits fairly well in that this is the swing high, and we move this down to the swing low. We come over here and clone this and bring this to the apex point, and we see that our apex point falls right here at 1350, 1360 range, and the second measured move that we do is our breakout point to our new support zone. We were only supported for about a day, but I drew it nevertheless, and it comes down to this exact same level as the larger apex pole that we drew before, call it pole number 1. So this pole to the support, we clone it, we bring it to the next breakdown range, and we see that it runs all the way down here to about the 1350, 1360 range again. So this would be the complete measured move in my opinion, and I have this outlined by this rectangle right here. Let's move on to the 15. A couple of divergences taking place and gap fills to fill, I guess. Let's show these gap fills here on the candlestick chart. They are fairly large, and usually gaps get filled at one point or another. For example, we can see that we broke down here, and this gap was filled eventually. We came all the way back up, we filled it, and then we got rejected. But the point is that we filled this gap, and we have two gaps over here. One, it looks like from 1695 to 1685, people woke up and they were down $2. The next one comes right here from 1695 to 1685. So we will be looking to fill those in the hopefully short to near term future. This divergence that I've got right here is marked by this stochastic making a high, a higher high, and a even higher high right here, and this is a low and a lower low. So this is a large divergence in my opinion. It is a multi-day divergence, and second divergence that I see comes from this right here making a high, higher high, higher high, same scenario, and over here we kind of have price coming towards this exact same level, even though our stochastic has been moving up steadily. So that would be something of interest to watch for the coming days. On the 5-minute chart, here's like the definition of why divergences how they should be treated. So divergences occur when a technical indicator moves in the opposite direction of the price of its underlying asset. Under the right circumstances, a divergence can be an early sign of a major price reversal, allowing traders to anticipate and take advantage of a change in trends. And that's all we can do as traders really, is to put the probability of a predicted price move in our favor. it's kind of like poker, but not at all at the same time. It's like poker in the sense that if you have the statistical probability, oftentimes it's worth a shot at that hand. And that's basically what divergences give you, is just an added, probability on your side that something might take place. So here on the 5-minute, let's go back to our Heikin-Ashi. I think it's easier to see. We can kind of see a descending triangle take place. This black line right here is pretty firm resistance right now. We've bounced off of it several times when in comparison we've only bounced off these for shorter time frames, for shorter timelines, and fewer times. Here we bounced off once, twice, 3 times, 4 times. Resistance, broke out, and fell back below it. So there's a lot more happening at these levels, which would give further weight to the power of these measured moves, because this measured move is fairly accurate in predicting the bottom. If this is the bottom, this green line once again is the lowest price from last year at this exact same time. This extremely high CCI right here shows that sellers are starting to exit the markets, or starting to exit this ETF. Let's go to the 1-minute. So the only divergence that I could see here in the 1-minute really is when this trough happened down here. We have a bull buy setup where price makes a high, or stochastic makes a high all the way into this, and then price makes this, it doesn't respond. We see I have the degrees here. We have a 6-degree move upwards, and this is a 50-degree move upwards. So price and stochastic are not correlating as well as they should be. At the end of the day, we see a lot of bulls coming in and buying at these prices, which gives me some confidence that tomorrow we might see our first green day, which I'm sure that a lot of people would be happy to hear. This blue line marks the apex of this descending triangle right here. And I think it's interesting to note that the low of the day was exactly at basically this apex area right here. So this is just kind of an interesting thing to look at when you're charting, is if you draw a pattern, always look at the ultimate ending of that pattern. And in this case, we can see that it's fairly significant. We can see this was my original pattern, which I had drawn. I thought that this was a false breakout. And the apex of this was actually still fairly significant because we gapped up the next day. However, we were rejected off of what I concluded to be the new and legitimate descending triangle resistance line. And over here, we can kind of see the exact same thing happen. This is the lowest low of the day, and I'm interested to see what will happen tomorrow for natural gas. Let's move on to US oil.